I've watched billion-dollar enterprises collapse, not because of market conditions, not because of leadership failures, but because they trusted the data that was incomplete, misinterpreted, or just plain wrong. One wrong number, a decimal in the wrong place, a mislabeled column can steer an entire organization, of course. The irony is most executives don't even know it's happening until the auditors walk in. It's like marketing protein bars to vegans because your data says health conscious is equal to a protein lover. Can you imagine that? If you're a small business, you're even more vulnerable to bad data because every wrong decision hits your cash flow directly. And I often ask leaders when I meet them, when was the last time you assessed your data? If you're experimenting with AI, have you checked your data modeled? On what data is it being trained on? And every time it's the same reaction, it's just pure silence. Today, I'm breaking down 10 reasons bad data quietly bankrupts good companies and how to spot them even before they destroy yours. I'm Noel DeCosta, and over 20 years, I've been the person companies call when their data breaks their business. I've led digital transformations across governments, airlines, defense, retail, and manufacturing, overseeing programs worth hundreds of millions of dollars. I watched data failures wipe out profit margins, delay billion-dollar mergers, and destroy forecasting credibility. And every digital failure I've encountered, whether it be in SAP, whether it be in Oracle, in AI, or in any cloud deployments, it all came down to one root cause: the business trusted the wrong data. So let's go through the 10 killers one by one. If you're like most teams I work with, at least five of them are already happening within your organization. The last three are the most dangerous and the most ignored. As we go through the list, I want you to score yourself and stay till the end of the video because the last three will actually tell you where you stand. Because if any of these three apply, you're not managing data, you're managing damage. So the first one is wrong master data is equal to false financial reality. One of my defense clients had a mystery. Their ERP showed clean books, everything balanced, but their cash flow was millions off. When we dug deeper, we found two vendor records for the same vendor, and all it was a space between their master data names, so the name of the vendor. One had old bank details as well, and the other one had new ones. The ERP didn't question it. Finance paid both. $2.3 million gone. Real money. Paid twice, actually. Unrecoverable. Now, you might ask me, how did this happen? Is because today's systems have, or ERP systems today have a setting called vendor invoice management, which basically, as soon as an invoice is deployed within the system, it automatically determines that that this invoice needs to be paid if there is a purchase order and if there is a GRN. The CFO said something that I never forgot. We have a system that never lies, but it also never tells the truth unless we feed it with one. So, how did we turn that situation? We overhauled the vendor master, merged the duplicates, and locked it with governance rules. The leakage stopped overnight, but the damage to credibility stayed. And so for me, the lesson here is bad data is silent corruption. It makes fake profit look real. And if your master data isn't reviewed at least quarterly, your reports might be inaccurate, but they're not telling the truth. The second point is a data lag is equal to slow decisions, and that relates to slow outcomes, which is lost money. I visited a friend of mine who works for a premier airline that most of you would have traveled on for sure. I remember my friend who was the CFO proudly showing me a weekly dashboard of performance metrics. And he said, Noel, every Friday morning, like clockwork, I get my reports. But I kept thinking, fuel prices were fluctuating every day. When the oil spiked midweek, their hedging teams could not react because the system hadn't refreshed yet. By Friday, the market had moved. Millions were lost in 48 hours. He realized every day of delay wasn't just lost time, it was a bleeding wound. So, what did we do? We replaced static reports with near real time feeds from both operations and finance. Decisions went from being reactive to proactive. So, that was done through a real good middleware that we created with the right level of integrations, and it was real time. So it was every 1 hour, it was the data was getting fed back into the system. And so the lesson for me is you don't lose money because of a bad strategy. You lose it because your data told you the information a little too late. And so decision velocity minus speed times your accuracy is the most valuable metric you're not tracking today. The third killer is departmental silos is equal to multiple versions of truth. So I was in a transformation boardroom, and along with me, there was the CEO, the CFO, the CMO, the head of supply chain, all senior guys, all sharp. The CEO asked, "What's our current revenue?" A simple question. Finance said 410 million US. Sales said 430 US million. And marketing said 445. Now, the CEO didn't get angry. He leaned back and he said, "If you guys can't agree on one number, we can't agree on which direction to go." And so every department had its own system, its own logic, its own version of truth. Everyone was right, but inside their own silos. And so when we were asked to fix that issue, we aligned the data definitions and synced the sources and unified the model. In the next quarterly review, it was one number. And the conversation finally shifted from getting the numbers right to actually taking decisions. And so for me, the lesson is when teams are busy debating whose report is right, no one's executing. And so you have multiple versions of truth. That doesn't mean diversity, it just means it's a dysfunctional company. And so this is my take. Make sure that you have one single source of truth. When it comes to your key KPIs, make sure that you clearly define what is the definition of revenue and do it for all departments so that everybody is aligned on that. So the fourth killer is forecasting errors plus the AI amplification. Let me give you a story. Right after COVID, a major retailer launched an AI forecasting model trained on pandemic era buying confusion, right? Because during the pandemic, everything was crazy, including buying patterns, because people were more focusing on, buying specifically things that they required, but the spending pattern changed because many of them didn't have jobs. So it learned from stockpiling, panic orders, toilet paper surges, not normal demand. And the AI didn't understand that context. The reason being AI is basically looking at a trend of data and then determining what should be the next trend. So it just saw trends. So it projected demand 18% higher than the reality. So as a result, the warehouse was filled with products no one needed anymore. Cash got stuck. And the board thought the sales were slowing down, not realizing that the forecast was broken. What we did was we cleaned the training data, stripped off the COVID noise because it didn't make sense to only focus on COVID. We reweighted the real buying patterns, and within 2 quarters, the forecasting accuracy jumped 40%. So let's be clear, AI doesn't make you smarter, it just scales your mistakes faster. And so if your AI model isn't audited quarterly, you're amplifying old errors at machine speed, right? Something you really want to avoid. The fifth killer is no data ownership is equal to zero accountability. So once I was sitting with a room of executives and I asked the question, who owns your finance master data? There was silence. 10 seconds passed. Then someone just stood up and said, everybody does. And I think it was more of a knee jerk reaction than anything else. And that's when I knew no one owned that data. So 14 people were actually editing the same SAP tables. There was no validation, there was no accountability. And it was like tiny errors turned up into the systemic failures. Why? Because everybody was making changes and it wasn't really a coordinated effort. So what we did was we are reassigned ownership. Finance owned finance data. Supply chain owned materials. HR owned the workforce data. And suddenly errors dropped and accountability returned. Now, where do you normally see these type of situations? You see this in a very fluid shared services setup, right? And it's great to have shared services. There is a lot of benefit in having it. However, you need to have the right structures in place. If you don't have this right structures, it's just going to be chaos for you. And so if data ownership isn't on someone's job description, it's already broken, right? And governance shouldn't be considered as red tape, it's insurance for the truth. So the sixth main killer is misaligned KPIs is equal to competing truths. So a consumer goods company launched a big promotion to clear excess stock before the quarter ended. Marketing declared it a huge success, leads up to 50%, if I'm not wrong. Finance flagged a cost spike. Operations couldn't fulfill, and production wasn't ready. So each team actually hit its KPI, but the company lost around 5 million US dollars. So what we did was we had to fix the issue. So we built KPI structures to align with business outcomes, profitability, delivery accuracy, and margin contribution. If KPIs don't roll up to one business outcome, you're not driving performance, you're funding an internal warfare between the teams. So KPI alignment is the difference between collaboration and cannibalization. So the seventh killer is over reliance on dashboards, which is equal to an illusion of control. At a strategy meeting, the leadership proudly shared their favorite slide, a dashboard full of green boxes. Everything was on track. 2 months later, they announced a 10% layoff. Now, it doesn't make sense, right? So you're doing very well on your sales side, but at the same side, on the same tone, you're saying that you need to drop 10% of your workforce because you're not making the right numbers. It turned out that the dashboard that they were pulling their data for one particular feed was coming in from the test environment. And so the real system had been read for weeks. So they trusted the chart, not the system feeding it, and no one checked it. And they were in a hurry to get it to production. So in that energy boost to say, let's put it into production, nobody really went and checked to say, where is that data coming from? So what we did was we added data lineage tracing. Every dashboard title now linked to a real life system. So there are no more blind spots. There's no more false confidence. And dashboards doesn't mean control. They just make you feel safe. But green always isn't good if the pipe feeding it is broken. And so one of the things that you really need to focus on is making sure that the data is coming from the right source. Do an audit to assess whether that is actually happening. So we come to the last three, which is very critical. Ignoring operational data is equal to marketing disconnect. So I worked for a luxury retailer many years ago, and I follow them because they are my old employer. And so one of the things that I heard about was they were pouring millions into a high profile campaign for a new product line. Beautiful creatives, flawless targeting, viral traction. But 30% of the SKUs were missing in transit. And what does that mean is that the SAP system that they hadn't updated the availability of the SKUs in time. So The marketing team celebrated the engagement spike because, from their perspective, they met their KPIs and even exceeded it. Meanwhile, when the customer hit the buy button, they got out of stock. And then the frustration just went all over the building. So I was called by the CEO. I'm still in touch with him. And he told me, he said, Noel, can you help us? And we said, okay, let me have a look at it. So we realized that the marketing data wasn't synced with the ERP data. So we synced it first and promoted what could actually be shipped because the stock was actually available. And so the campaign ROI jumped 45%. No extra spend because that element of the sales strategy was doing perfectly. And so you cannot advertise what you cannot deliver. And yet many do every day. So your marketing data must talk to your supply chain data, or you're just storytelling, right, without any stock. And that's affecting your reputation. The ninth killer is dark data is equal to your missed signals. An international airline, noticed refunds rate creeping up slowly, quietly for over a year. We scanned their refund logs and we found tens of thousands of agent comments buried in free text fields, which no one had ever read. Hidden in those notes was a pattern. One specific route had a recurring pricing glitch. And so they lost millions slowly and silently over a course of a year. There were no alerts. A lot of these things you don't get the red flags. It's just silence, but you see it in the numbers. And so one backend config fix that we implemented, which was maybe around 5 minutes of work, stopped the leak completely. All discovered in the data that no one thought to check. And so your next business insight is sitting in a text field no one reads. Dark data isn't irrelevant, it's invisible ROI. The last and the final one is that a leadership blind spot is equal to a trust without verification. So a CEO once told me, very proudly, if it's in the dashboard, I trust it, otherwise I don't. So 2 months later, the dashboard showed record profit. The bank account, for some reason, was overdrawn. Doesn't make sense, right? If you're showing profit, why is your bank overdraft overdrawn? So then the finance team traced it back. The journal entries were being duplicated during consolidation. And so they presented the presentation of truth instead of verifying that particular truth. So what we did was we implemented a verification protocol, reconciliations. I know all of you would have heard of it. Data lineage checks and health audits, right? As soon as we implemented these, the confidence returned, not because it looked good, but because it was real. And so the lesson is bad data doesn't show itself automatically, doesn't scream itself out. It whispers until the balance sheet exposes that particular lie. So the leadership's job isn't to trust data, it's to verify the trustworthiness of that data. So bad data doesn't bankrupt you overnight. It corrodes your accuracy, your confidence, your credibility, and one decision at a time. And the real loss isn't the money, it's the decision made on fake truth, right? What's the worst decision your business made because of bad data? Even if three of these sounded familiar, you're not managing data, you're just managing the damage that it's being caused. So, in the next episode, I'll show you how a $1 error in your ERP can quietly turn into a $10 million financial risk and how to detect it even before the auditors do. If you're a CIO or a CFO or a transformation lead and some of this hit too close to home, this is the work that I do, right? I help enterprises rebuild trust in their data in their ERP systems, in their AI systems, through audits, through governance frameworks, and just basically truth alignment. You can connect with me on my website. The link is in the description. And let's uncover what your data isn't telling you before it turns into another headline. That's the last thing that I want. So I'll see you in the next one.